Okay, welcome back. We are on part H for chapter 20, and that is page 13. So we're going to go through and do a sale type lease. And again, we're focusing on the lessor. Entries are the same as for the financing type lease, except we have to record a sale and cost of goods sold amount. Because remember, it has a profit margin in it, and I'll show you how to recognize that in a question. And they're only recognized for the portion of the asset that's sure to be realized. So, the gross profit on the asset sale is the same whether residual value is guaranteed, but the present value of unguaranteed residual is not included in either sales or cost of goods sold. If guaranteed, it is included. And we'll do an example. So on page 14, we're going to do example 5. So again, focus on the lessor. So January 1st, 2020, Lavery Corp, they're the lessor, which follows ASPE. Leased equipment to Cullenber, which follows IFRS. Well, we don't care about Cullenber, we only care about ASPE right now, because we're Lavery. Now, technically, we should go through the classification questions on page 8 to see if it is a finance type lease. But you already know how to, just don't want to repeat it. So we know it is already. So we're just going to go through it. So term of the lease is 6 years, no renewal option. Equipment reverts to the lessor. It's going to have a residual value not guaranteed of $6,100 at the end of 6 years. Cullenber depreciates its equipment on a straight line. Because we're not Cullenber. Now, bear in mind, you guys, some of the problems you do have the information for both. So you could technically, from one question, do both sides of the lease. The lessor and the lessee. Equal rental payments are due January 1st of each year. Now, here's the key thing. The equipment's fair value on June 1st, 2020 is $155 and its cost $111. So, right there, when there's a difference like that, you know it's a sales type lease. Okay? Because you're going to recognize a profit. Your payments are going to be based on this 155. So you're definitely going to be seeing a profit. Okay? Okay, Lavery set the annual rental to assure a 12% rate of return. Cullenber's incremental borrowing rate is 13. Do we care about that? Nope, because we are only doing Lavery. Of course, if you were doing Cullenber in the second part, you'd need to know that. Ability of lease payments is reasonably predicted, no important uncertainties. That's that. Those are the last two conditions for ASPE that we talked about. So you'll see that in most questions if they have someone's using ASPE. So, first thing we're going to do is calculate the annual rental payment. So, remember, begin has to be on. Present value is going to be negative $155,000. Use the fair value. N is 6. I, now that's a question. Do we use 12 or 13? Or who sets the payments? The lessor. So we only care about our rate. So whenever you're figuring out the payments, it's always the lessor's rate. And the fair value, remember, guaranteed or not, is going to be 6,100. Notice fair value, present value, two different signs. You could have reversed it. This could have been positive. This could have been negative. Totally up to you. So you compute and you get 32990. Now, just like the other example that we did before, you have to calculate gross investment, net investment, and then the unearned interest. So, gross investment. If you remember from page 12, or if you go back and look, it's the undiscounted, because this is going to become our receivable. So we take the undiscounted payments, so 32990 times 6, plus the 6,100, and that's guaranteed or not. We would always add that on. And that works out to 204,040. Then we take the net investment. So this is the fair value or the present value of the gross investment. So as I said last time, our little calculation here, whenever we do this for the lessor, we are setting the payment so that we receive the fair value. And notice here, this is the gross investment. It all goes in here. So there's the payment, there's the 6 years, the lessor's rate, and the 100 gives us the 155. So that net investment is going to be fair value or present value. Either way, it's 155,000. And of course, the unearned interest is just the difference. $204,040 minus 155,000 equals 49040. So now we could do a little table and schedule just like we did with the other ones, starting off with the net investment and going through. But you can practice that on your own. We're going to go right to the journal entries. So January 1st, 2020, at lease inception. So we're going to set the lease up first. Because it's easier than combining it with the payment, okay? If you need to in Wiley Plus, combine these, which it usually doesn't, but if it does, then just write them out separately and then put them together. So you're going to have 2 debits and 3 credits. So we know we've got a lease receivable, and that hasn't changed since last time, and it's the gross investment. So that's simply 204,040. Now, what else do we know? Well, we calculated unearned interest, and we know it's a credit. It's a liability. Unearned interest income is 49040. So those are both from our little calculations above. So what is leaving our warehouse or our business? Well, because it's like a sale, it's going to be inventory. So inventory is leaving, and of course we're going to record it at cost. Whoops, sorry, it's 111,000. And that's going to be at cost. So, for both cost of goods sold and sales. So we're going to have a sales, we're going to have cost of goods sold, inventory. We need to know the present value of the unguaranteed residual. Because on the last page, we said unguaranteed residual is not included in sales and cost of goods sold. So we have to take it out. But we need the present value. So what we do over here is we're going to calculate present value of unguaranteed residual. So present value equals, we don't know yet. Future value is 6,100. N is 6. I is 12. And we're just bringing it back to time now. So there's no... And present value equals 390. So our cost of goods sold is going to be cost minus the value of unguaranteed residual. So that's going to be 111,000 minus 3090. And that'll work out to 107,910. Now, just make a little note here. If guaranteed, don't subtract. Okay, so that's our cost of goods sold. To do sales, you could just fill in the blank, or you could realize it's a net investment minus present value of unguaranteed residual, which is 155,000 minus 3090, which is 151,910. If it was guaranteed, don't subtract. So that's the chart about the sales type lease. You just kind of have to remember all the pieces. Now, luckily, you've got an open book exam. You'll have everything in front of you. But don't count on that for the CPA. Okay, let's go to page 15 and finish off the entries, and we can finish this chapter. So, January 1st, 2020, the actual payment, we get cash and credit lease receivable for the payment calculated 32990. Then December 31st, 2020, we need the year-end interest. So we know we debit the unearned because now some of it's earned. Interest income and credit interest income. Now we didn't do our little table, so we have to think. First of all, what rate do you use? Well, we know it's 12% because it's the less ors. And we start off with the net investment, which is 155,000. And remember, the full payment reduces it. So that works out to $14,641. And I'll just write that under here. It's min investment minus the full payment because it's year one. If you need to, just use this piece of scrapper and draw out a little amortization table if you want. Okay, just some additional items. Well, you can read through that. Yeah, just read. The very last part of this chapter is accounting for an operating lease as a lessor. You're going to be getting cash and crediting rent or unearned rent. And the leased asset stays on your books, so you also have to do every year. Because it's on your books. Notice in the previous examples, the asset left, so we didn't depreciate it. Okay, hopefully that made sense. Here's the suggested problem, and as I said earlier, exercise 2016 is an operating lease. And that's it for chapter 20. Just for you guys, chapter 20 is a huge chapter. It's got a lot of pieces, so don't beat yourself up if it feels crazy right now.